and thanks for joining us for our online homebuyer workshop presented by HomeOwnership OC. We're going to go ahead and get started. If you do have any questions, feel free to put them in the chat box and the question box. We'll answer those as we go through. And please also complete our online intake form if you have not done so already. We do need that in order for you to obtain your certificate. So it's on our website at homeownershipoc.org. Right when you click on our website, it says complete online intake form, and you can complete it and send that in to us once we receive it. And you complete the workshop, then we send over your home buyer certificate. All right, well, it looks like lots of folks have joined us. We're going to go ahead and get started. Again, thanks for joining us for our online home buyer workshop presented by HomeOwnership OC. We are a nonprofit HUD-approved housing counseling agency. And a little bit about myself. My name is Connie Dertrosian, and I have 20 years experience in the nonprofit housing counseling world. I also am a HUD certified housing counselor, so I should be able to answer all of your questions. If not, we have lots of lender real estate partners that will be happy to reach out to you and get you the answers. My contact, and I've also sent you some emails, so you should have it. And feel free to reach out to us if you are interested in one-on-one counseling after the workshop. So a little bit about HomeOwnership OC. We, as I said, nonprofit, HUD-approved housing counseling. Our mission is to promote and preserve the dream of homeownership, and we do education, counseling, and financing. We've done lots of workshops like these, also on credit, avoiding real estate scams, foreclosure prevention, all of that good stuff. So we've been around since 2007, and we do partner with the Fair Housing Foundation. They help us with some rental and fair housing. So if you do have any fair housing questions, we will be going over that. You can reach out to us, and we will refer you over there. Our website, homeownershipoc.org. All right, so as I mentioned at the beginning of the workshop, today you'll be earning your HUD homebuyer certificate. We're breaking this up since it's an online class into two sections. We will be taking a little break in between the two sections. First part, we'll be talking about your readiness to buy. We'll be talking about credit, savings, spending, and a little overview on the mortgage loan. Second part will be shopping for a home, managing your debt, protecting your investments, fair housing. I've also added a little bit of information about fair housing and the next steps. And then we'll be done. You'll get your certificate. So we're going to be hanging out together for a few hours here. So get comfortable, and please let this be an interactive workshop. So feel free to ask questions. So, you know, whatever questions you may have, we'll stop intermittently to answer questions. And again, if you haven't completed that intake form, we are going to go over the budget section. So I'll give you some time to complete that. So at least complete that intake form and work on the budget part because we're going to be discussing it tonight. All right, so let's start with homeownership, the advantages and the disadvantages of homeownership. First off, with homeownership, you'll have control over your environment. You'll have more stability, especially like with rents going up. You know, you'll get a fixed rate mortgage and your mortgage amount will be the same pretty much. So you won't have to worry about rent increases anymore. There's a lot of tax benefits with homeownership. You get to write off a lot of that interest, so it will help you with your taxes and getting money back. And it really is the #1 way to build equity and assets for you and your family. If you think about it, how long would it take you to earn or save $100,000? But you can certainly do that by purchasing a property, staying in it for a few years, and you can build $50,000 to $100,000 in equity fairly easily. It is an appreciating investment. Of course, the disadvantages are there are no guarantees. There is some decreased mobility in that you would have to sell the house, and you are responsible for maintenance repairs. There are some additional monthly costs with taxes and insurance, and it is a long-term investment. So it does take some time to build that equity. So it's a long-term investment, but I say you're going to have to live somewhere, so might as well invest in some home ownership. I really think the advantages outweigh the disadvantages in home ownership. Also, when we're comparing renting versus buying, of course, as a renter, you're really only responsible for gas and electric, but as a homeowner, you'll be responsible for gas, electric, water, trash, property taxes, homeowner's insurance. You'll have to do your repairs and maintenance. And if you do buy in a community that has HOAs or Mellows, you'll be responsible for that as well. So there's some additional costs, which is why it's very important for you to go through the class, understand what those costs may be, to make sure that you can afford and be mortgage ready when you're on your way to homeownership. So let's map out a plan to meet your homeownership goals. First, we're going to talk about affordability, and it does depend on several factors. Number one, how much money do you make, or your annual gross income, your credit history and score, what current mortgage rates are, how much are you going to put down, your down payment source, the type of home you're going to buy, current lifestyle and future plans, as well as fees and closing costs. There are some additional costs when purchasing a home, so you do have to have some money saved. So usually when I first start talking to clients about home ownership, I say, do you have a good paying job? What's regular steady income? What's your credit score? And then how much money do you have saved in the bank? Usually we need some money for down payment. Even if you're going to get some down payment assistance, which we're going to talk about tonight, you're still going to need probably $15,000 to $20,000 for closing costs, because there are some costs associated with the purchase, escrow, title, all of that good stuff, appraisals. So you are going to need some money for those closing costs. We will talk about some closing cost grants and down payment assistance that can certainly help you, but you do need to have some money saved. And there's some circumstances in some programs where you may need as low as $5,000, but could be anywhere, depending on your situation and the price of the home that you're buying, could be much more than that. So it really depends. So what are the steps in homeownership? First, you prepare yourself for homeownership like you're doing tonight. Then you determine how much you can afford. You'll then apply for a mortgage loan, get your mortgage loan pre-approved, decide the type of home that you'd like to purchase. Then you'll go shopping for a home, make an offer or counter offer, get a home inspection, and complete the tasks that are necessary during escrow, and then close the loan. So those are basically the 10 steps in home buying. So we're going to go over each one of those and really dig in deep and see what did those mean and what do those entail. So of course, HomeOwnership OC provides support for you in that we provide education, of course. You'll be getting your HUD certificate tonight, which is necessary for most first-time buyer loan programs and down payment programs. We provide coaching, counseling, one-on-one counseling as well if you need that. I'll send you an email. You can let me know, and we'll connect you with our HUD housing counselor. And then post-purchase counseling, if you do have problems after you purchase the home, you're having trouble making your payments, we do help with foreclosure prevention, credit, and servicing issues as well. So, we're a one-stop shop here. All right, so we're going to talk about savings and spending. So it's a really good idea to track your income and expenses. Use a savings and a spending plan or a budget. I like to call it a spending plan because it sounds a little bit better, and really track where our money is going. You can review and make adjustments as necessary, see where you can trim. You can also figure out ways where you may be able to save and set patterns to boost your savings, especially if you're getting into homeownership. Like I said, you're going to need some money saved up to pay for some of those additional expenses. And, you know, we talk about putting some money aside in your homeownership fund and how to do that on a regular basis to reach your homeownership goals. You should also know what your triggers are for overspending and address the underlying causes for that. You know, if you get stressed out and then go shopping, maybe you can find something else, another way to relieve the stress without spending money. You can go for a jog or take a dog for a walk or something like that. So it is really important to have a savings and a spending plan. Lots of people, you know, call it budgets, but sometimes it can have a negative or positive positive inclination when you talk about budgeting. So that's why I like to call it a spending plan. So let me know what type of words come to mind when you talk about budgeting. What do you think the benefits are? And does anybody currently have a budget? Do you keep a budget? What type of budget tools do you use? We're going to talk about some tools that are really beneficial for you. I know a lot of people think, you know, budgeting has a negative connotation, but I like to call it a spending plan and say, this is how I'm spending my money. And when you have control over it, if you know, I have $3,000 coming in, but I'm spending $3,400, so that's not a sustainable plan. Then we need to figure something else out, either increase the income or decrease the expenses to make sure that we have a balanced budget or balanced spending plan, you know, we need to end up cutting some of our expenses so that hopefully we can end up saving some money. All right, so send me some information if you currently do have a budget. Send me what you use. Some people use an Excel spreadsheet. Some people write it down. Let me know what kind of tools you're using. All right, so why do you think it's important to have a savings and spending plan? Especially when it comes to buying a home, a savings and spending plan can help you estimate what you can afford to pay in a mortgage, identify where you may be able to cut some expenses. You can also develop a stronger loan application, prepare for any additional costs, and it can provide you with some motivation. So we talk a lot about your credit, also about your debt to income ratios. And this is what lenders are going to be looking at when they try to qualify you for purchasing a home. So really important to know how much money is coming in, how much money is going out, what kind of debts you have, and to pay down those debts so that you're in a better shape for homeownership. So there's a couple different tools that you can use for tracking your savings and spending. You can use a notebook. Some people like the old-fashioned way of just writing it down anytime they spend money. There's lots of, there's a calendar. You can do it as you get paid on a biweekly or monthly basis. There's a lot of online tools. I like mint.com, and also I'll put that in the chat. And it's a really great tool to use to help you track your spending. You can also create a budget in there. And if you do online banking, it will connect to your bank account, and then every time a charge comes in, it will assign it a place. So if you say, I want to spend no more than $300 on groceries, you can say that's my budget. It will track everything that goes, you know, all the expenses that you have for grocery stores and put it in the grocery budget and let you know you're either $50 under, $50 over. So it's a really great tool. I like mint.com. It was created by Intuit, the people who do the tax software. It's really smart, super simple to use. And like I said, if you're connected to your bank and do online banking, you can connect your bank account. It tracks your spending, kind of does everything for you if you like those online tools. So I understand that a lot of people don't like the online tools. So you can go ahead and do the notebook. You could write it down. Some people just like to put it in an Excel spreadsheet. Some people like to keep their receipts. Also, some of the banks, also, as you do your online banking, they have some tools as well, some online tools. So feel free to use what works best for you. We have a simple budget form that I can send you. That's an Excel spreadsheet. And as I said, I am going to ask for you all to complete your intake forms and make sure that you have completed the budget section. So even if you have a negative connotation of the budget, we're going to do it tonight. So please complete that for me. I sent you the link in the chat so that you have it. You can be completing it as you're listening, and we're going along here, but we are going to go over the budget section. All right, so, and again, if you have any tools that you'd like to share, feel free to send them to me and I will share them with the group. I'm always looking for new, interesting ways for us to utilize some online tools or other things that people use to track their spending. All right, so we also need to establish a savings plan. As we're developing our spending plan, we need to determine our gross monthly income. We also need to calculate our monthly expenses, and we're going to calculate what our total gross monthly income is. Then we'll calculate our total monthly expenses, subtract one from the other, and hopefully we have a positive. And at the end, we'll see if we have some extra money, and then we can utilize that money for our savings plan. So if you're in the negative every month, then we need to make some adjustments, right? This is one of the things that a housing counselor does. We always require all our clients to complete a budget form because we want to know where are you at in your process. Are you at least sustaining your expenses every month? Are you negative every month? Do we need to make adjustments? And or do we need to start a savings plan if your goal is home ownership? So housing counselor can help you with going over all of that, paying down your debts if that's your goal too. So how do we determine our net monthly income? That's the money we earn after taxes and payroll deductions have been taken out. You could also include any other monthly income if you drive Uber or you babysit or do dog walking or whatever, dog sitting, you can utilize that money as well. We can put that on our income section if it's regularly, comes in regularly every month, and we deposit that money into our bank account. It's really important to track that money to show that if we want to utilize that extra income, we have to show that it's in our bank account, right? And on a regular basis. All right, so this is the part where we're going to complete the budget and income sections of our intake forms. If you've already done this, you don't need to do it again. Just pull it out, pull out a copy of it so we can review it. And as I said, today we're going to be going over, we're going to create our very simple budget. So on our intake forms, we're going to list all the income for all of our family. You would be the borrower, and if you have a spouse or partner, somebody living in your household that contributes to your household, you can put their income in there as well. And then we're going to put down our monthly household expenses. And it doesn't have to be exact. It can be, as close to what your expenses are on a monthly basis. So don't forget to put your rent or housing payment in there as well. And then we calculate all of these. We're going to add these all together, get our total monthly income. Then we're going to calculate our total household expenses. And as I said, this is a pretty simple form. We can send you a much more detailed form if you'd like one in an Excel format. And it calculates everything, adds everything up for you. It has a couple more sections. Now for like insurance, if you pay it on a quarterly basis, just figure out what you pay, what you would be paying on a monthly basis, and write that amount down. So I'm going to give you a minute here to complete your budget sections. And then hopefully we'll, go over it, and we'll be in the positive. All right, so hopefully you guys have completed this section already. I know a lot of you have already sent me over your intake forms. So let's go over some of the expenses that you'll have. So their expenses can be fixed, flexible, and periodic. So fixed expenses, examples are your monthly rent, fixed pretty much, right? On a monthly basis, you're paying the same amount of money. Flexible expenses could be gas, right? Gas may fluctuate a little bit if you're driving a lot or gas prices are high. Groceries, maybe your kids are home from school and so you're spending a lot more on groceries, so that could be flexible. Periodic would be something like your car insurance paid quarterly or things that are paid quarterly, not necessarily on a monthly basis. So as I said, as you're filling out that budget section, you can just put down the monthly amount, because we really want to track how much money is coming in every month and how much money is going out every month. All right, so let's figure out if we have any extra monthly income. We're going to calculate the total monthly income, subtract the total monthly expenses. Hopefully, at the end of the month, we've got extra income coming in. And we have a surplus at the end of the month. That's what we like to see, is that you have money and at the end of the month, and hopefully you're putting some of that money set aside for an emergency fund. We like to see 3 months of an emergency fund. So that means you could pay your bills for 3 months if something should happen, and you have that amount saved in your bank account. 6 months is even better, but 3 months at a minimum. All right, so as you're doing those calculations, all right, so let's see. Somebody needs the link for the intake, so I'm going to go ahead and send that in questions box. So the link to the online intake form is, I'm sending it in the chat box, also in the questions box. And if you go to homeownership.org, the first thing that pops up is a little red box that says complete our online intake form. So it's on our website, but I also sent the link in the chat box and in the question box. All right, so calculate your budgets, and let's see at the end if you do have extra monthly income using this formula. Hopefully you do. All righty. So there's lots of different tools, as I said, where you can track your monthly spending. You can do it with that mint.com. You could do it on an Excel spreadsheet. You could do it on a, there's lots of budget apps out there. So each month we created this budget, right? So now we want to track it over a few months and see how are we doing? Are we staying within our budget? So each month you can fill in the actual amount spent. You can track it for 3 months to be really accurate, or at least 30 to 60 days. And as you're looking at this, you can track which costs seem to be over the planned amount every month. How important is your homeownership goals? Are you ready to consider trimming some flexible expenses? And are all of your household members willing to follow the plan? Of course, if you have kids, they're always asking for things, want to go to the movies, want to, need to buy new soccer cleats or, new football or whatever it may be. So you do want to put some money aside for some of those expenses, but have your little slush fund. But once you've reached that, then it's time to start saying no, right? So that we can really tighten up our budget and make sure that we're meeting our home ownership goals. So take a look at your budgets as you're tracking your spending and see what costs seem to always be over the planned amount and what can we do to get those under control. Sometimes, your cable is going up, then maybe you can call them and talk to them about signing up and getting some discounts, saving some money over on a monthly basis or with your phone bills. And take that money that you were used to saving or used to spending and put it in a savings plan. So it's a really good idea to set up a homeownership goal action plan, boost your savings. As I said, you are going to need some money coming in. You're going to need some skin in the game, right? So it's important to pay yourself first. So what I like to do is once I pay all my bills, then I say, you know what, I'm automatically going to put $200 in my savings so that I don't even see that every week. So by the end of the month, then I have $800 in my savings account. If I get tax return and I have extra money, I'll put that in my savings as well. So, or, if you do happen to get some extra money, get a bonus or something, you can put some of that into a savings plan. I always told my son as he was growing up, when he got money from his birthdays or Christmas or whatever it was, I said, you can spend some, you can also put some aside into your savings, and then you can, have some fun money to give away or do what you want with, right? So you feel free to spend some of the money, but at least some of the money needs to go, 1/3 of it needs to go into a savings plan. So he had a few $1,000s in there, by the time he graduated from high school. So it's a good idea to teach your kids good spending and savings plans as you go along as well, so that they understand the value of money. And again, if you do get extra money, you can put that into a savings. I like to, if you want to create a specific homeownership savings, you can set up a separate savings account. And as I said, as you get paid each week, bi-weekly, monthly, set aside a certain amount of money to be put into the homeownership savings plan. So I like when we set up those automatic savings things so that they go automatically in there. We don't even look at it, and you'll be surprised at how much money you can save when you don't even look at it, right? You're just automatically putting funds in there. All right, so let's move on. So some good money management tips, of course. Pay your bills on time, keep your credit score high, or if you need to improve it, now is the time to improve it before you get into homeownership. We want your credit score to be as high as possible so you're getting the best rates. And be sure to control your day-to-day spending. And of course, create a spending plan and stick to it. Makes no sense if we create this great budget and then we don't stick to it. So we do need to be able to take control of our spending. A lot of people feel empowered once they do this, and then they start seeing Even I'll tell you, our counselor, one of our counselors, came to me and had bad credit, wasn't paying her credit cards on time, and thought, there's no way I could buy a home. And I said, listen, if you listen to me, you pay down your bills. She had collection accounts. She had all kinds of stuff on her credit. So she was able to do that. She paid off her credit cards. She paid off the collection accounts. She negotiated with them and paid them down. Started saving some money. I said, just start automatic savings. She's already got $25,000 for a down payment, and her credit score is in 700s. And when she came to us, it was like in the 500s. So it is possible. It doesn't take too much time, but it does take diligence. So it really is possible. And it can happen to anybody too. I understand credit happens, right? Things happen. And so sometimes we're not able to pay our bills, but we just have to be responsible with it and, take ownership of it and handle it. So what is credit? Like I said, when I first start talking to clients, the first thing I ask them, how's your credit score? Do we need to improve it? What do you got going on there? So credit really is an x-ray of your financial health. And of course, the better the credit, the better the rate you're going to get. So lenders are more likely to give you a loan if you've handled past borrowing responsibly. A higher risk loan from a lender's perspective will mean a higher interest rate. So when you're working with us, we want you to get your credit score as high as possible so that you're getting the best rates. We want you to pay down your debts so you have very low debts that you need to pay off. And believe me, I'm going to show you how you're going to save money by having a higher FICO score. So here's a quick little chart that shows a good credit score and how it pays off. So let's just take, for example, a 30-year mortgage on a $250,000 home. And let's say you've got a FICO score of 620. So, all right. So let's say your annual percentage rate would be 5.6. Your monthly payment would be $1,448. Total interest paid over the life of the loan would be $271,448. Now, if you had a higher FICO score, let's say you'd have a annual percentage rate of 4.096, monthly payment of $1,207, total interest paid $184,670. So that's like almost $100,000 less in interest paid over 30 years, and your monthly payments less about what, $240 or something. So it really does pay to have a higher FICO score. You'll end up saving on your monthly payments, total interest paid, hopefully a better interest rate. All right, so as you see, higher FICO score equals lower payments, more savings. All right, so how do we determine where we're at? First thing we're going to look at is our credit report. Your credit report is a detailed summary of your credit history put together with credit reporting agencies. There are 3 credit reporting agencies: Experian, TransUnion, Equifax. All right, so did you all know that you have the right to a free credit report from each of the 3 major bureaus each year through annualcreditreport.com. So you can go to annualcreditreport.com, you can sign up and get your credit report from each of those 3 bureaus, and it's completely free. During COVID, they weren't limiting it to just once a year. I'm not sure what they're doing now, but you can certainly look at your credit. So how many people here have actually looked at their credit report within the last 6 months? Send me a message in the chat. And if you haven't, then you're going to do this. You're going to put this on your to-do list, and you're going to do it by the end of the week, okay? Super simple. Sign up for annualcreditreport.com, pull your credit report, take a look at it, make sure that everything that's on that credit report is accurate. If it's not, it's very simple to dispute things. They actually have a place where you can now dispute it online. You can upload documents, send it to them. If there's something on there that shouldn't be on there, they do have to review it within 30 days and take it off if it is incorrect. Now, accurate things they're not going to take off, right? But if they put something on there by mistake, mistakenly put a late payment, you can dispute it on them. Also, if there's things on there that shouldn't be on there, they have to respond to you within 30 days. So it doesn't provide a credit score for free, but there are some other tools, free tools like Credit Karma, Credit Sesame, Experian. I think you can sign up for it. They do provide the credit score. It's a general credit score, maybe from just one of the credit bureaus, but I'll give you an idea of where you stand. My Fico is also a website that allows you to purchase all 3 credit scores. Bankrate is also a website that allows you to get your FICO score. You can also check out credit cards on there and rates. If you're looking to build your credit, you can do that. Awesome. So it looks like Tamika's looked at it. She's got a 704. That's an excellent credit score. So always good for you to look at your credit. I mean, even if you're not, ready to purchase, look at your credit report, know what's on there, because there's lots of personal identity theft. There's a lot of data breaches now. So it's really important for you to be looking at your credit and making sure that everything that's on there is accurate, and disputing things and getting things off if it's not accurate. And if you've got a great credit score, great job, keep it up, right? Because it's going to save you money in the long run. If you need help with credit, you can come to us, do some one-on-one counseling. As I said, we'll show you how to pay down those debts, work with collectors, and pay those debts off in order to improve your credit score. So there's 2 types of credit pulls. There's a soft pull or soft inquiry, which does not affect your score. And then there's a hard pull or hard inquiry that does affect your score and is an in-file credit report. Soft pull would be just somebody looking at your credit to see if they want to extend credit offer to you. A lot of counseling agencies, if we're pulling your credit, would be a soft pull. Hard pull would be I'm trying to buy a car, I'm maybe applying for an apartment, maybe you need it for your employment, and they're actually going to run a hard inquiry. That does affect your score. So what makes up our FICO score? It's based on 5 main categories in our credit report. Higher scores are better scores, of course. Consumers are generally between 300 and 850. And a higher FICO score means you're likely to pay lower percentage interest on a loan. So 35% would be our payment history. So how we pay our bills, pay your bills on time, that's the most important thing. Amounts owed would be 30%. Length of credit history is 15%. New credit and types of credit used are 10%. So again, payment history is the #1 thing, and how to improve your credit score. So if you're behind on payments, late on payments, get current on payments, work with them, call them to try to get current, and start paying those bills on time. Amounts owed is also 30%, so that also will affect your score, impact your score. So with payment history, avoid closing accounts with positive payment history. What I say is, even if you're not using the credit card, keep it open with a 0 balance on it. Maybe use it once in a while and then pay it off at the end of the month, right? So you're not paying any interest and you're keeping it open so they don't close it. Keep making your payments on time. If you have to just make the minimum payment, at least make the minimum payment. You can sign up for automatic payments as well to make sure that if you're traveling or whatever it is, that you're making your payments on time. What I like to do is use my credit cards, get the points, right? Pay them off at the end of the month. So I use it to pay my cable bill, car insurance, all of that, but I pay it off at the end of the month. So I carry no credit card debt. So you're using it, but you're paying it off. Amounts owed, So if, let's say, for instance, you have a credit card with a $1,000 credit limit on it, you want to use 30% or less of your available credit and other revolving debts. So that'd be $300, right? Once it starts creeping up to 50 or higher percentage, or you've maxed out, it will lower your credit score. So you want to keep those balances below 30%. As I said, best way to do it is to use your credit card, pay it off at the end of the month. Use it, pay it off at the end of the month. And you can work with a housing counselor to pay down your credit cards if you're looking to purchase a home, so that we can increase your debt to income ratios, get you all mortgage ready. So new credit is 10%. So shopping inquiries, you should do it within a 14 to 30-day window. New lines of credit, of course, purchasing furniture, co-signing could definitely negatively affect your score. If you are going to be purchasing, you're in the process of purchasing, you don't want to go out and purchase furniture or car, things like that. Can affect your ability to, because they've qualified you on your current debt to income ratios. Your credit report should reflect accurate information, accurate payments, and again, if you're already working with the lender, always get the lender approval before making any changes to your credit profile. Really important that you don't change things up, because it could affect your ability to purchase. So what's the best way to boost your credit score? Pay your bills on time. If you miss payments, get current, stay current. Be aware that paying off a collection account will not remove it from your credit report. If you are having troubles making ends meet, contact your creditors, work out a repayment plan, or come see a credit counselor. You can work with our counselors, and they'll help you get back on track. A lot of times you just need to contact your creditors, tell them, hey, I had a financial hardship, but I'm willing to pay you, work out a payment plan, and believe me, they'd rather have something than nothing. Don't use those debt consolidation places, because most of those are not trustworthy. And they're doing what you can do, what I'm telling you, you can do yourself. As far as amounts owed, keep your balances low on credit cards and other revolving credit. Pay off debt rather than moving it around. Don't use your unused credit cards as a short-term strategy to raise your score. Don't open new credit cards that you don't need just to increase your available credit limit. And for new credit, do your rate shopping within a given period of time, 14 to 30 days. Know that you can reestablish your credit history if you've had problems in the past. And note that it's okay to request and check your own credit. So we've given you those tools. Hopefully you will take advantage of them and utilize them. So any questions on credit, collection accounts, things like that, you can negotiate with them. A lot of times they will take less than what they bought that debt for pennies on the dollar. So you can negotiate with them for a repayment to make payments on it, or, if you happen to come into some cash, you can call them and say, hey, I got $1,000, it's a $1,500 debt, but I'm willing to give you $1,000 for it. I'll pay you today. And if they say no, you say, okay, well, I got another credit card. I'm going to call that one and make negotiations with them. So a lot of times it just takes some negotiating, but really important for you to know what's on your credit report and get rid of those collections, late payments, things like that, and provide positive things. All right, so we're going to discuss we're going to do an activity here, and you tell me who has the higher credit rating. We have Susan, Jonathan, and Maria, okay? So Susan has an annual income of $31,750. She has a car loan for $12,760. She has one credit card that's paid off. Second credit card has a limit of $7,500, and she has $4,000 balance on it. She's never missed a payment on her credit cards. All right, so that's Susan. Then we have Jonathan. He has an annual income of $52,000. He has no car loan, no credit cards. He pays everything with his debit card or cash. And then we have Maria. She has an annual income of $40,000. She paid cash for her car, so she doesn't have a car payment. She has one credit card with a balance of $12,000 and a limit of $12,500. And she has missed 2 payments in the last year traveling. So out of those 3 individuals, who do you think has the highest credit rating? Would it be Maria, Jonathan, or Susan? What do you think? Send a message in the chat or the question box. Let me know what you think. Is it Susan, Jonathan, Maria? All right, looks like Susan, we got some votes for Susan. Susan, 1 for Jonathan. All right, good answer. So it is actually Susan. She's got the best, the highest credit score, that she uses her credit wisely. You know, her balance is a little bit high, but she does pay it down. She's never missed a payment. Now, Jonathan, you would think would have good credit, but he actually, if he doesn't have any credit cards, he has no credit, which could be seen as bad credit, right? So Jonathan needs to get a credit card. He needs to start building his credit. So what we usually say is get a secured credit card, go out and get a Target, Walmart credit card, use it, pay it off at the end of the month. And start building your credit. You can also do this if your parents or spouse or somebody will put you on their account and get you a credit card, and on their account, you can start building your credit that way as well. I just did this for my son, and he's got like a 700. I think his score is higher than mine, so he was really excited about that. All right. And Maria needs to get on auto pays because you can't be missing payments just because you're traveling, right? And she needs to pay down some of that balance because the balance is creeping up really high, close to maxing out her credit cards. So, bankruptcy, how will it affect your credit? It will factor into the score as long as it remains on your credit report. Chapter 11 and 7 is 10 years. Completed Chapter 13 is up to 7 years. It will affect your ability to qualify for a mortgage. And, you will have to rebuild your credit after claiming bankruptcy. It may wipe everything out, but then you're going to have to rebuild your credit. So it depends on how quick you do that. So before you're considering bankruptcy, what I say is talk to a credit counselor, evaluate the situation, because a lot of times if your debt is not that high, we just had a client who called me and said, I'm thinking about either bankruptcy or doing these debt consolidations. And I said, look, you can work with our counselor. They can advise you on how to pay down your debts, come up with a payment plan. We usually say pay off the highest interest credit cards first, pay those down. That's all that a debt management company is going to do. It's going to consolidate everything for you, charge you one monthly fee. And they say they negotiate the amount down, but they don't. Okay, I mean, they're making money on it too. So I really don't recommend those credit repair places or the debt management places, because I think you can either do it yourself. Sometimes bankruptcy is the answer, but you will have to go through some counseling before you make that determination. So, but I say talk to a credit counselor before you consider that. So your credit score is based on information in your credit file. It takes into consideration all the positive and negative information in each category. It has no memory of your last score. So even if you've had a long, ugly credit history, your score will be weighted in favor of your latest performance. So start paying your bills on time. Put some positive things on there to replace the negative. The further you get away from the negative, the higher your score will be. So you're given points for positive, points taken away for negatives. So it's important to reestablish positive credit to offset the negatives. How recent, frequent, and severe the negative is will impact the score. Negative information does season out. As you begin to utilize credit responsibly, you can improve a negative score. So it didn't take you, overnight to get bad credit. It's not going to be overnight that you're going to improve your credit. It may take a couple of months, depending on what you've got on there. You may have to negotiate things. You may have to pay down some collection accounts. As I said, you can usually negotiate with them and pay them for less than what's owed. Sometimes, 50% of what the total debt was. It just depends how long ago it was. So it's better to negotiate those things and pay them off, work on paying those down, be able to improve your credit score. So, myth about credit report is no one can remove accurate information on your credit report. I've heard people say, oh, you can take a foreclosure off, a bankruptcy, a short sale, all of this. You can't, okay? It just takes time, and you can rebuild your credit. No one can legally create a new identity for you, and legitimate companies are going to provide a service before requesting payment. There are credit repair laws that regulate credit repair, so it's really important to know what your rights are, and I will tell you, majority of those companies are not legit, okay? They may dispute things on your credit report, and they'll go away for 30 days, but then they come right back, because if they're legitimate, they're gonna come right back. If it's a legitimate thing that happened, it's not getting erased from the credit report. What I say is take the money that you would have used for the credit repair, because they are going to charge you a fee for this, and use it to pay down your debt, or get a secured credit card from their local bank and start rebuilding your credit history yourself. You can do this all on your own. Really important to start with your credit and make sure that you're rebuilding and getting things improved. Try to do this on your own. As I said, you can look at your credit report, annualcreditreport.com. You can send your own dispute letters. You can dispute it online, very simple to do. Lots of sample dispute letters and free publications at credit.org. And again, you can come to us. We'll help you for free in providing credit improvement counseling. It's also important for you to know your rights, the Equal Credit Opportunity Act and Fair Housing Act. You have the right to have a mortgage application reviewed without consideration of race, religion, age, national origin, sex, marital status. The Fair Credit Reporting Act, you have the right to a free credit report once a year, and you can dispute settlements for errors. The Fair Debt Collection Practices Act guarantees users' rights in dealing with debt collectors. You don't have to let them harass you over the phone, say you're going to jail, call you at all hours of the night. For more information, you can go to fdc.gov and find out more about your rights as a consumer. All right, any questions on financing? On credit, sorry. We're going to jump into financing a home and go over some mortgage terms. And then I do have a lender online tonight, Veronica with PNC, who's going to be talking to you guys about down payment, more specifics about loan programs and how they work. So we've got some really great information. And then once we finish that, then we will be taking a break. And then we'll come back and wrap up the workshop. So any questions, send them to me in the chat box. I'm happy to answer them. All right, so let's dive into what is a mortgage loan. Mortgage loan, which is also known as a deed of trust here in California, is a secured loan agreement between the lender and buyer, in which the property is the collateral for the loan. So when you don't pay your mortgage, they can foreclose and take that property back. You'll usually work with either a mortgage broker or loan officer to apply for a home loan. Mortgage broker is an intermediary between the lender and and the customer, and they will shop from different loan products from different financial institutions. Loan officer usually represents a lender or financial institution and may work for a specific bank, like PNC, Bank of America, Chase, Citi, whatever it may be. All right, so who originates mortgage loans? We have traditional banks. They're traditionally the sources of mortgage loans and have many different loan products. Most all of them do have some kind of first-time buyer loan programs and down payment assistance. One advantage of borrowing from a bank is you can keep all your financial activity in one place. There's also mortgage companies. Mortgage bankers are individuals who make loans that are secured by mortgages on homes. One advantage of borrowing from a mortgage company is that they specialize in mortgage loans and they have loan programs at, good interest rates, various programs and loan products, right? You can also get a loan from a credit union, which is a private bank run by and for its members. Again, they usually offer good mortgage terms, fees, and rates because they're membership-based. Then we have some nonprofit organizations or community development organizations that receive grants from the government, and they can provide, they can lend money for home purchases. One advantage of borrowing from a nonprofit is that interest rates are often less and less than what banks would charge, and repayment terms are easier. There's easier guidelines to qualify because they really specialize in first-time buyers. We then have government agencies, state or local housing finance agencies. Here in California, it's Cal HFA. Most every state has a finance agency, and they provide financing for special uses, especially first-time buyers. So one advantage of borrowing from a government agency is that they have financing available at lower interest rates or may require lower down payments, lower closing costs for low to moderate income. So it's really important for you to look for down payment assistance programs and grants in your area where you're looking to purchase. We're going to go over some of those that are available here in Southern California. But as I said, most banks do have some type of first-time buyer program, down payment assistance program, usually requiring you to attend the workshop that you're attending tonight. So, but it's a good idea if you're looking in a certain area to go to the county and city in those areas and do a little bit of research to see what kind of programs they may have. So your mortgage payments, also known as PITI, or principal, interest, taxes, and insurance, is all those four things. That makes up your mortgage payment. So principal is the part of the mortgage payment that's applied to the original amount borrowed. Interest is the amount that the lender charges for lending you money. Remember that chart with the Fico? We were showing how much it costs over 30 years. That's the interest. Taxes, that's the part of the mortgage payment used to pay your property taxes. And then insurance is the part of the mortgage payment used to pay your homeowners and sometimes mortgage insurance. So an example for a $250,000 home, if we were putting 10% down, that'd be $25,000. Term is 30 years. Property taxes, we estimate those at 1.5% of the purchase price. And homeowners insurance can be an average of $800 to $1,000. Just depends. All right, so what are the factors that affect your payment? How much you put down, right? So if you put more money you put down, the lower the loan amount is. So the lower your payment would be. Repayment terms of loan, is it a 30-year fix, which most everybody gets? Or are you doing 15-year or something? Obviously, your payment is going to be a little bit higher. If the loan term, the longer the loan term is, the lower the payment is. The interest rate and does the property that you're purchasing include homeowners association fees or mellow roofs? So HOA fees are usually attached to condos. can range from $200 to $500, $600 a month on top of your mortgage payment. And then Mello-Roos are special taxes for areas in new areas where they may charge you money taxes for schools and lights and streets and things like that. So you want to know these things going in, because if you have an HOA fee, you have Mello-Roos fees, may reduce the amount that you're able to purchase, because we'll have to reduce the amount of your mortgage loan to be able to compensate for that. All right, when we talk about affordability, you'll hear terms like housing payments, debt to income ratios, things like that. So we're going to do a quick little overview of what it looks like to be pre-approved for a loan. When we're looking at affordability, you'll often be pre-approved for a loan when your housing payments and debt payments are equal to or less than 43% of your gross income. So there's actually calculations that a lender is going to do when they're qualifying you for this mortgage. So they're going to look at your housing payment, which includes mortgage, property taxes, property insurance, HOA dues, if applicable. They're also going to look at your debt payments. What do you have on your credit report? Loans, car loans, credit cards, child support, any revolving debt. And then they're also going to look at, what is your savings? How much money do you have in the bank? So we look at your income, housing debt, housing expenses, and we want your housing payments and debt payments to be equal or less than 43% of your gross income. So we're going to do a quick little overview here. As I said, what we like to do with our first-time buyers is make sure that they pay off all their debts, right? So you don't carry any credit card debt. You don't have those extra. If you have a car loan, you try to pay that down or pay it off, because the less debt you have, the more purchasing power you have. So in the situation on the left, we have with 5% of our income used for paying off debt and 38% available for my housing payment, this individual is able to qualify for a higher mortgage loan, right? Because they're carrying less debt. On the scenario on the right, if they have 15% of their income allocated towards debt, and then they have 28% towards housing, then you, of course, have less money available for your home purchase, right? So you have less purchasing power. So that's why we say, if you have credit cards, pay them down, right? Don't have those monthly payments. You have auto payment, pay it down or pay it off before you go purchasing a house. So you have more money available when you go into purchasing the home. So there's little quick math that they do in calculating your housing ratio, which is the maximum percentage of a borrower's income that can be used for a monthly mortgage payment. Let's say your monthly housing cost is $2,000. Together, husband and wife bring home $6,000. That would make their housing or front-end ratio 30% of their income, right? Simple math. We're doing all simple math here. So that would mean 30% of their income is available, $2,000 available for their housing costs. When we talk about debt to income ratios, that's the maximum monthly amount the borrower can spend on a house payment plus their debts, right? So debt to income ratio includes all of your debts. So let's say we've got that $2,000 payment for our housing. We've got $300 on a car payment and $200 on credit cards that we're making on a monthly basis. That'd be $2,500. So we take $2,500 and we divide it by our monthly income of $6,000. So our debt to income ratio was 41%, which is a good DTI, right? It had to be under 43%. So though each situation varies, a front-end ratio higher than 38% or a back-end ratio higher than 43% signals you may need to lower your debt, control your use of credit before purchasing the property. All right, so you don't have to worry too much about this because lender who's going to qualify you is going to do all these calculations. But in us getting you prepared for homeownership, I want you to know what kind of calculations they're going to be doing. All right. So how do we calculate our monthly payments? We'll multiply our gross income by 43% for the standard back-end ratio, then subtract our monthly debt payments from the total, and this is the amount that we could afford to pay each month on a mortgage. So doing the calculations backwards, we're going to take our $6,000 monthly income, multiply it by 43%, subtract that $580 that we're paying for our car payment and our credit cards. We get $2,000. So $2,000 is my affordable monthly payment. All right, so as you can see, if I didn't have that $580, right, I could have a higher payment every month available for my mortgage. And with higher costs, you know, housing costs are fairly high here in the Southern California area. You want to be able to have as much income as you can available for your mortgage payments. There's also what's called loan to value, and that's the ratio of the loan balance you owe to the appraised value of the property, used during the loan approval period to gauge risk. A higher LTV percentage, the lower the risk, and the typical lower interest rate, lower LTV, the higher the risk. You guys don't need to necessarily understand all of this. As I said, the lender's going to calculate all of these calculations for you. So, but I just want you to know this is what they're talking about when they're talking about loan to value. An LTV of less than 80% is ideal. All right, so a little bit about different types of loans. We have government insured loans or guaranteed loans, conventional loans, non-conventional loans. So government insured loans include loans from private lenders that the government insures or guarantees, such as FHA loans or VA loans, USDA loans, etc. Conventional is any loan that's not insured by a government-sponsored entity like FHA, and we have conforming and non-conforming. And then we have non-conventional loans, which carry more risk to the lender and investor, usually offered when a conventional loan is not obtainable. And they have funky ones coming out now, hard money loans and things like that that you don't want to be involved in. Trust me, you're going to either go government insured or conventional. We have fixed rate and adjustable. Fixed rate, it's fixed for the life of the loan. Majority of the people that are getting loans are getting fixed rate loans. Typically a 15, 20, or 30-year mortgage, where at the end of the term, the loan is paid off in full. The pros is the payment does not change over time. As I said, it's steady over the life of the loan. The cons are that the payment remains the same, which could be higher than it would be with some different type of loan. Typically, you know, the loan rates were in the 2s and 3s. Now I think they're in the 4s and 5s. Still very low, so most people are not getting adjustable rate mortgages. Adjustable rate mortgage would be initial fixed rate period. It's fixed for a period of time, 2, 3, 5, 7, 10, or 10 years. And then the rate adjusts upward or downward depending on mortgage terms. As you know, rates have been going up. So you wouldn't want to have an adjustable rate mortgage. The benefits are that the initial payments may be more affordable, but the cons are the payment may increase after the fixed rate period. So, as I said, most of our first-time buyers go with a fixed-rate loan. There are special home buying programs from federal, state, local governments, private, public nonprofits also have programs to help you afford homeownership. Majority of them are targeted to low to moderate income individuals and first-time buyers. And just so you know, a first-time buyer is anyone that hasn't been on title for 3 years. So even if you owned a property 5 years ago, sold it, now you're renting, you'd still be considered a first-time buyer as long as you haven't been on title for 3 years. There are usually eligibility and other requirements for these special homeownership programs, and most have income and or geographic requirements. So, question for you all. If I make $100,000 and I have no debt, how much can I afford to buy? If I'm, say my spouse and I together, we make $100,000. What do you think? Well, I'm going to do a quick little math here for you so you can see from this chart. All right, so we go to the 1, 2, 3, 4, 5, fifth column, the light blue column. We look under, okay, $99,599, almost $100,000, right? With no monthly debt, I can afford to purchase a property at, let's see, $550,000. If I'm putting down $19,250, loan amount would be $530, and monthly payment would be $3,735. Now, let's say I have $500 of debt. My purchasing power goes down. I'm looking at a house for $475. My monthly payment is going to be $3,226. Now, if I have $1,000 worth of debt, it goes down even further, right? So then I'm looking at something in the $400,000 range. So again, the reason why I do this scenario is to show you that less debt we have going into homeownership, the better off we are, right? You can carry some debts, but if you can pay them off, then you have more available for your purchasing power. It puts you in a better situation. All right, so we do have Veronica who's on the line. Let me go ahead and unmute her here. And I'm gonna promote her to a panelist. So you should be able to unmute yourself. Oh, sorry. All right, Veronica, are you there?
I am.
Oh, perfect. Okay. All right, so we have Veronica Hernandez. She's with PNC Bank, and she's agreed to go over some of the slides and answer your questions in regards to, she's an actual loan officer with PNC, so she can answer your questions if you have questions about mortgages, rates, and she's going to go over some of the down payment assistance programs that are also available. So thanks for joining us, Veronica, and go ahead and take it away, and I will advance your slides for you.
All right, thank you, Connie. And welcome everybody to today's workshop. And today we're going to talk a little bit about the entire process of the loans and the different types of down payment assistance programs and what they're designed for. What are the intentions of the down payment assistance programs? It's designed for first-time buyers, borrowers who need to have a lower down payment option, and borrowers with less than perfect credit. So we have the three different government agencies that Connie had talked about earlier in regards to the FHA, which is the Federal Housing Administration. Those are government-backed loans. So those are loans that that we still do as lenders, but the government backs us up and says, you know what, this person, even though their credit may not be 100%, we're gonna give you a guarantee so you can go ahead and do the loan for them. So both FHA, the VA, and the Home Ready possible, or the USDA loans, all of those are backed by the government. So just to kind of let you guys know the different types of loans that are out there. Of course, the VA, you've had to have served in the military as an active member, a reservist, a National Guard, or been or married to one of these categories of the military. Unmarried surviving spouse as well would qualify for these type of loans. So if we can go to the next slide. On the next slide, we have the community lending programs. The community lending programs are great because these offer you a low down payment. It's a low down payment program, and a lot of times, depending on your particular situation, if you qualify for these type of loans, not only are you going to do the 3% down, but you also get some type of grants through the different banks. So Wells Fargo right now is providing $750 in closing costs for attending your home buyer education that you're attending today, and up to $5,000 in grant. Bank of America provides $7,500 in closing costs and $10,000 in down payment help. PNC offers a grant of $5,000 for down payment or closing costs. And it's both for first-time buyers and for, like, if you were to refinance or if you were to sell a house and buy a new one, you would qualify for that grant as well. There's alternative credit evaluations and flexibility on the ratios. So a lot of times what that means is that we can qualify you for things that have a different qualification than the regular conventional loans would qualify you for, because it is a specific program that we have for our, normally it's for the low to moderate income areas or first-time buyers. We also offer FHAs. Most banks will offer FHAs and VA loans. FHA, you have to have a 3.5 down payment. The great thing about the VA loan is that you don't need a down payment at all. And normally with those two, there's like mortgage insurance involved. With the VA loan, it's a very nice type of loan. Of course, you'd have to qualify for it as well. There's minimal down payment requirements. There's more flexible guidelines than conventional loans. And there's no income limits on these type of loans, on the FHA and the VA loans. On the community, it may be a little bit different. You may have to qualify based on the tracking census or the income. So there's a little bit of a difference on the two different programs, but of course, that would be when you're ready to get into details, make sure that you ask your loan officer. So if we can go to the next slide. Closing cost assistance. There's a lot of lenders out there that provide closing cost assistance programs to help first-time buyers to buy a house. And it goes towards closing costs for the qualified buyers. Like I said before on the previous slide, sometimes it's income qualifications that you have to have, and sometimes it's the area that you're buying in that would qualify you for these type of assistance. So that may eliminate upfront closing costs. There's no repayment required. So a lot of times there's different programs where you do have to repay that, whatever it is, that money that they give you. With these grants, you don't have to repay that back. And with the closing assistance, you don't have to repay that back, which is really nice. So it's free money. And you can combine that with other community lending programs. So you can combine these closing assistance programs, the grant programs, with other down payment assistance programs as well. Some of them will not allow you to combine them, and some of them will. So you just have to do a little bit of research and find out the ones that do and the ones that don't. We can go to the next slide, please. And so there is a great program out there right now, which is the WISH program, and that's available. It's only available for first-time buyers. It's forgiven after 5 years. And it can help with either the down payment or the closing costs or both. it's for a first mortgage with the approved lender only. So you'd have to get approved before being able to qualify for this type of program. And the advantages of this program is that it provides up to $15,000 for each participating household, matching up to $3 for each dollar that you as a homeowner is contributing to buying your house. So you're putting in $1, they're putting in $3 for you. So that's a great opportunity. And I mean, it's forgiven after 5 years. So again, you know, free money out there. The application process allocates funds for homeownership based on program eligibility. So you have to make sure that you qualify for this program. And I'm sure that, you know, when you're going through the counseling, they can provide you with more information on where you can research this information and on whether you would qualify for something like this. And you can combine it with other programs as well. Okay, if we can go to the next slide, please. So right now we have the community assistance programs. So these are funds to assist with down payment and closing costs or closing costs. They're provided by nonprofit organizations, federal, state, and local agencies as well. The repayment may be required or forgiven over time. So depending on the program that you get involved in, it may be that, you know, after 10 years of you living in your house, that's forgiven. And then there's some programs that are going to require that you pay them back when you either refinance or sell your house. So those are details that you also have to be aware of when you're applying for these programs. You know, you have to figure out, okay, is this going to be forgiven in, you know, X amount of years, or do I have to repay it back? And of course, the reason is you want to make sure that if it's forgiven in 10 years and you're there for 9 years, you might want to stick it out for another year until it could be forgiven for you, you know? Definitely, you know, why not take advantage of free money? And it's a considerable amount of money. So OC down payment, the city of Santa Ana has they just increased it recently, up to $120,000 in a down payment assistance program. It went up from last fiscal year, which was $80,000. And you can go into the city webpage so you can see those. And a lot of cities have actually increased their down payment assistance program amounts. I've seen that here in San Diego County as well, and LA County as well. So if you've seen what is out there before, revisit the counties to see the increases on each one of them, because it looks like all across it's really they've all increased significantly. So 80,000 from the County of Orange. You do need your mortgage credit certification, which is a 20% tax credit. So in order to get that, you would have to go through the counseling as well, and they can provide you with additional information on how to get the mortgage credit certification. And then CAR, which is a $10,000 down payment grant from participating nonprofits. And again, your counselor can get you a little bit more information on how to qualify for that down payment grant from CAR. If we can go to the next slide. So do you have to attend a homeowner education class and get a certificate to qualify for down payment assistance program? What do you guys think? Go ahead and put it in the chat and let me know what you guys think. If you guys need to attend this home buyer education class or not. Most of these programs do require that you attend a homeowner buyer education of some sort. So you want to make sure that you hang on to that certificate that you're going to get, because it is going to help you qualify for basically free money. So we're going to go to the next slide. And the next slide gives you a few other programs available out there, like the Cal Plus first, which is the Cal Plus, which is for first mortgage loans insured through mortgage insurance. And it is for a 30-year term. It's combined with CalFed with the zero interest program for down payment assistance and closing cost. There's also a program of My Home Assistance. It's a deferred payment with a simple interest rate subordinate loan that provides up to 3% of the sales price or appraised value of the property, whichever is less, and must be recorded in a second position. So this one here, My Home Assistance, is a loan. It's not a grant. So those are the things, and it's 3% of the sales price, which is amazing. I mean, that can make a difference between you paying mortgage insurance and not having to pay mortgage insurance, which we'll go over a little bit later and in the presentation on the big difference that even, you know, you see 3% and that may not seem like a lot to you, but it can definitely make a big difference in your payment. So we'll go over that. Like I said, mortgage insurance, we'll talk about that a little bit later. But just remember, you know, how these things all add up and how it may impact your payment. CalFed Zero is a zero interest program. You do have to qualify for this program. The qualifying ratios is 45%. It's a mandatory home warranty insurance and home buyer education. So these are definite. So the Cal ones, CalFA is a forgivable home equity builder loan. It offers a down payment loan of up to 10% of the purchase price, which is forgivable after 5 years. So after 5 years, that 10% of, let's just say you're buying a house for $400,000. So they're giving you a loan for $40,000, but after 5 years, it's forgiven. So, I mean, why not take advantage of things like that? You know, it's definitely something that if you're planning to stay in a house, if it's your forever house or if it's your even long-term house, you know, 5 years is not that long. You know, apply for these programs, take advantage of the money that is out there to be able to get you into your first home. You do have to attend home buyer education. It is only available for your primary property, so you can't buy like rental property or a second property with these programs. But I mean, most of the time, you know, we're buying our primary residence, and there are income guidelines, so you do have to qualify based on your income as well. So those are the things to look for, and definitely ask more questions to your counselor in regards to these programs, because they're great programs that are out there and available for you to take advantage of. I mean, like I said, this is forgivable. Take advantage of it, definitely. The next one is grants. So the Golden State Financial Authority is a grant. It provides up to 5% of the loan amount for eligible home buyers that never has to be repaid. So grants are normally that. It's money that's given to you by either the state, the federal, maybe the lender. It can come from different sources, but when you hear grant, it's going to be money that you don't have to repay. When it's a down payment assistance program, there is you want more details. You want to get more information on whether, you know, you have to be there to have it forgiven, but it's normally a loan when you're doing a down payment assistance program. It is available in all counties throughout California. So this is something that is statewide. Borrowers do not have to be first-time buyers. They can even own other properties. So for this program, even if you have another property and you wanted to buy that secondary home, if it's a rental, I believe if it's your secondary home, it has to be your secondary home. You can buy a secondary home and be able to, and you can rent it out as well, and be able to take advantage of this grant. And 5% is, again, it's a big deal, and it can make a big difference on your payment when it comes down to paying mortgage insurance and not paying mortgage insurance. And the requirements are really simple to qualify for this type of program. FICO scores of 640 and above. And then your mortgage loan type has to be conventional and it has to be a Freddie Mac loan. So there's two different ones that we normally use, and I don't want to confuse you guys, but Freddie Mac is one of them. So just know that they are the entity that we normally use to be able to service the loans and to be able to do the qualifications. We use their guidelines to qualify our borrowers through Freddie Mac and Fannie Mae, but Freddie Mac is one of, I mean, they're both pretty big, but that's who we use as far as guidelines for almost every type of loan. So we'll go to the next slide, please. So here on the MCC program, I think I lost it. Okay. On the MCC program, this entitles the qualified borrower to take a federal income tax credit. Because the MCC reduces the borrower's federal income tax and increases the net earnings, it can help the borrower qualify for the initial loan. So what that means is that it pretty much, your mortgage credit certificate program allows the lender to use this federal income tax credit, not necessarily as your personal income, but it is credits that is given to you. So we can use that credit to qualify you for a larger loan amount. So that's the really nice thing about this program, is that it also provides for federal income tax credits too. So at the end of the year, if you're normally having to pay taxes when at the end of the year, then this could definitely help you avoid paying taxes or possibly getting some money back. The tax credit can be taken year after year. So it's not just the year that you buy your home, because a lot of times when you buy that first year, when you buy your house, you get other tax credits as well. Such as like if you buy points, then you can, it's a tax write-off. So there's a lot of benefits of you owning your own home when it comes to taxes, not just in being able to qualify you for this specific program. This mortgage credit certificate program will help you increase the loan amount that you can get approved for, but year after year, it also helps you reduce your tax liability. So this is definitely something that you guys want to take advantage of. It's an anticipated tax credit that can help first-time buyers qualify for the initial mortgage loan. So like I said before, it will help you qualify. So you know how Connie was talking about the debt to income ratio. This will help align your debt to income ratio. So if you have some debt and you're like, oh my gosh, I'm at, 45%, loan to value, so I'm not going to qualify for this program that I wanted to qualify for. Well, this mortgage credit certificate program can actually help with that debt to income ratio and get you qualified for the loan amount that you want or increase it. So we can go to the next slide, please. So we have the VA loan. The VA loan is a great program. The VA does not do the loans themselves, but they do guarantee it. Like I said before, most lenders will offer you a VA loan if you qualify for it. You do have to be eligible if you served for 181 days of active service during peacetime, 90 days of active service during wartime, or served at least 6+ years of service with the National Guard or the reserves. And you can only use it to buy, build, or repair your primary residence. You must be a veteran or active military, and your certificate of eligibility is needed as well. No down payment is required. And like I said before, with these loans, there's usually no mortgage insurance as well. Mortgage insurance is, you'll hear a lot of insurance when you're buying your house. The difference between your homeowner's insurance is that your homeowner's insurance is insurance that's going to cover your house in case of, let's say, a fire were to happen, or somebody breaks in, or things like that. Your homeowner's insurance is going to cover that. It's protecting your asset, right? Because your house is your asset. So that's protecting it. Your mortgage insurance, or you're gonna hear it either referred to as PMI, which is principal mortgage insurance, or MI, which is mortgage insurance. It's the same thing. Principal mortgage insurance and mortgage insurance is exactly the same thing. And what that is it's an insurance that covers your loan. It really doesn't do much for you as a consumer. So you're really just paying and it's covering just the amount that you owe. So it's not like, you buy gap insurance for your car. It's not the same. It's covering the amount that you owe on the loan. So you bought the house, you paid $300,000 for the house, but your loan is for $250,000. It's not covering that $350,000. It's covering that $250 that you owe the loan. So it's pretty much an insurance for the lender. It's an insurance for the bank. So if something were to happen, you can't pay it, the bank will still, it's guaranteed that, because the insurance will pay the bank. So that's pretty much what the mortgage insurance is. So it's not a bad thing, but it's something that you can definitely prevent paying, then prevent paying the mortgage insurance. If we can go to the next slide, please. Shopping for a lender. It is so important that you take the time to shop and compare and negotiate, because it could save you thousands of dollars. You want to check out at least 3 lenders. You want to make sure that you're comfortable talking to your lender as well. You want to make sure that you're comfortable asking all the questions that you have. If you feel like the person, your lender, is not giving you the attention or not giving you the answers of the questions that you have, then go to the next one. Because it is so important that you have that relationship with them. It is so important that you feel comfortable being able to ask any question, and don't be afraid to say, oh my gosh, I don't know this. Yeah, most people don't. So we're the experts. We're in the field. This is what we do on a daily basis. So you're going to find maybe a few lenders that are going to be like, oh my God, whatever. But most lenders are not. Most lenders are going to be happy and appreciate the fact that you have questions, because you want to ask all the questions up front. You don't want to have questions when you're signing your loan documents. I mean, and that's what I tell every single one of my customers. Please feel free to ask as many questions as you want, because I don't want you to have questions. Not that you're not allowed to, but I don't want you to have any questions when you're at the signing table. I want us to have that relationship and be able to talk about everything that you're going to see on that document, and that you fully understand what you're signing off on. Because you don't want to be caught with signing documents that you're not comfortable, or you weren't sure what you were signing. And then later on you find out, oh my God, there's a prepayment penalty, or I had to pay points and I didn't even know about it. Why is all of that important? Because there's certain things that you can do. Like if you're paying points, there's nothing wrong with paying points, but you can write it off on your taxes. That's something that you should have known at the time that you were doing your application. So that way, you know, okay, well, at the end of the year, I have to tell my tax person that I paid points when I bought my house. But a lot of times people don't know that because they didn't have that open communication with their mortgage officer. So not only will it save you thousands of dollars with your transaction, but it can save you thousands of dollars going forward, you know, that you know exactly what you're getting yourself into, and that you know that that mortgage officer is going to explain to you in details everything in regards to what you're paying for and the terms of the loan itself. So check your local state and financing programs. Read the mortgage lender reviews available at Zillow. We have it there. It's www.zillow.com/directory/mortgage lenders. Shop with your local credit union or your bank, and check your NMLS for brokerage information if you wanted to go through a broker. I definitely tell, you know, people, shop your bank, your primary bank, who you bank with first, and then shop two other ones. Because I mean, it's a lot easier to just keep everything in-house under one umbrella kind of. So that's one of the recommendations that I always have, is shop your personal, who you bank with first. So if we can go to the next slide. So comparing is important, especially when it comes to the cost, right? So cost comparisons, your loan estimate is going to give you really how you can compare. You can say apples to apples and be able to really see the actual cost of your loan. A lot of people will call me and say, hey, what is today's rate? And I can give them a rate. But if I'm not giving them like, okay, I need to find this out, I need to find that out, because different programs have different rates. And you can buy down points. You can buy points to get you a better interest rate. So, you know, just the interest rate, like if one person or one lender has a better interest rate than the other lender, one could have been quoting you with points and the other one was quoting you without points. So looking at the full picture is definitely going to help you make a better decision and going to help you make the better decision on who to go with. So what you're looking at when you're looking at your loan estimate, you want to look at your rate. You want to look at the annual percentage rate, not just the rate, but the annual percentage rate. And you're going to see both figures on there. They should be very close one to the other. You may see a big discrepancy in the interest rate versus the annual percentage rate. Ask the question, why is there such a big discrepancy on the interest rate versus the annual percentage rate? So ask your lender those questions. Buying down points, what does that mean? So buying points means, let's just say today's interest rate is at a 5.75. And I tell you, well, you know, I'm gonna be there for 10 years and I just want a lower interest rate. Then I'll come back to you and I'll say, okay, let's buy down the interest rate. So you're actually paying a fee up front to get you a better interest rate. A lot of times, the reason why that is done, paying the fees up front, is because you recoup the cost, you recuperate the cost that you paid in points by a lower payment because you have a lower interest rate. It may take you a little bit of time to recoup those costs, but if it takes you, let's say, 2 years to recuperate the cost of the upfront cost that you did by buying down the interest rate, by buying the points, but you're going to stay there for 10 years in that house or 15 years in that house, then anything beyond those 2 years that you paid is money in your pocket. So let's just say the difference between a 5.75 to this person bought it down to 5%, and the payment is going to be, let's just say, $200 difference. So it's going to be after year 2, after they've recuperated all of the cost, the upfront cost of buying down the points, that $200 a month is going to be your savings for buying down that interest rate. And that's one of the things, you know, you want a lender that is going to ask you questions as well, as far as like, how long are you going to be in your home? Because if you're only going to be in your home, if it's your first house and you plan to upgrade, or you plan to, you know, downgrade in 2 years, then you really don't want to buy points because it doesn't make sense. But if you're going to be there long term, you know, there's programs, there's, you know, buying down the points that will definitely make sense. And then there's down payments and the mortgage insurance. This is what we were talking about earlier. So PMI is the mortgage insurance, and that's the insurance that we were talking about, that it protects the loan itself. And then there's always going to be some fees involved with closing costs, right? So you want to look at those fees as well, and compare one lender to the other lender on like, how much is it actually costing me here versus somewhere else? Is there an origination fee here? How much is your origination fee here? How much is your processing fee here versus this other place? Now, when it comes to fees on the title, you could pick whatever title company you want, and the fee should be the same on the title. There's only a few fees that you will see that are lender fees, that those won't change. So your lender fees are your lender fees, and those are the fees that you want to look at when you're looking at the loan estimate. Your title fees, those can change based on the title company that you choose, and you have that choice on making sure that you choose whatever is going to be cheaper for you as far as the title company. And then the monthly payments, make sure that you're paying attention. So your interest rate may be lower on one loan estimate than the other, but then if your monthly payment is actually lower on the one that has a higher interest rate, then you want to look at that and see, why is your payment lower on the higher interest rate? And it might be that, you know, you're not paying mortgage insurance on one loan versus the other, or it might be that you're paying a higher down payment on one loan versus the other. So you just want to pay attention to all those things when you're looking at a loan estimate and you're comparing one to the other. That's the best way to be able to compare side to side on what the cost is going to be, what your overall cost is going to be, and if there's any way to reduce those costs as well. You want to talk to your lender about that. So if we can go to the next slide.
And one thing I was going to mention too is that as you, if anyone gets a loan estimate and they want us to go over it with them, we're happy to go over the loan estimate and explain the fees and charges and things like that. If they don't understand anything or they want to compare to, we're happy to do that as they go through the process.
Okay, and that is a great resource, let me tell you guys, because it is confusing, especially if you're new at this. It can be very confusing because you're looking at all these numbers. And I will tell you, I've had a lot of people that I've gone and done the comparison side to side with them. And I mean, 9 times out of 10, we look at the comparison and they're like, okay, I get it. I understand why this is this and why this is that. But you definitely want, like, if you're not understanding everything on there, because it is a lot. Like I said, there's a lot of numbers, there's a lot of fees, there's, and they break it down. So there's a lot to cover. So if, having them as a resource is, I mean, you guys don't know how lucky you guys are to have that resource. So take advantage of it. And this is what a loan estimate looks like. It has the date it was issued, look at the loan term, whether you're looking at the product, make sure that if you're talking about getting a fixed rate, that it says it on that loan estimate, that it's a fixed rate, the type of loan that you're getting, and then whether your interest rate is locked or not. That is super important. I would say that's one of the most important aspects of when you're applying for a loan, is to make sure that you're locking it in. A lot of lenders will take the application and then they forget to go over that process, and you're brand new, so you don't know that you have to ask them, like, did you lock in my interest rate? Because if interest rates go up, even though your application is already in, if that interest rate's not locked, it can change on you. So, if make sure that you're having that conversation with your lender. And then looking at the sale price and the loan amount is also very important. Looking at, like I mentioned, the interest rate, your closing cost, your estimated closing cost is very important, and the estimated cash to close. So the estimated cash to close is actually what you have to bring to the table the day that you're closing, the day that you're signing for your loan. You have to send either wire, get a cashier's check, or however the lender wants it. That is the money that you have to come up with to send to the lender to complete the transaction. And then look at your estimated payment as well. Like I said, what you really want to focus on is that principal and interest payment, because a lot of times, unfortunately, what happens is that some lenders, to make it seem like the monthly payment is lower with them, they'll put in like very low taxes or very low homeowners insurance. And I'm not saying that you can't get a low homeowners insurance if you shop around. You could definitely get a low homeowners insurance. But they do that purposely so that the monthly payment can appear to be lower than your competitor. But at the same time, your taxes are your taxes. You're going to have to pay that no matter what. There's no shopping around. It's just, it is what it is, right? That's your payment. You're going to have to pay it. You could shop around for homeowners insurance. But when you're comparing one loan versus another, you want to look at the principal and interest, because your estimated escrow is going to change. That always changes based on what you personally, it's just an estimate, but it's going to be what you personally choose as far as your homeowner's insurance. And then the property taxes can be different from what we initially estimated. So when you're doing comparisons, that's what you should focus on: principal and interest. Okay. Negotiate for the best deal. So what we were talking about earlier, making sure that you're asking the lender or the broker if there's any way to reduce the interest rate or pay fewer points. You know, just ask them, or even reducing the cost of the loan itself. Make sure that the lender, the broker, is not lowering one fee while raising the other. So like we said before, making sure that they're not giving you 4%, but they're having you pay a ton of points up front. So, making sure that you're paying attention to that. And then once you're satisfied, ask for a written lock-in guaranteed the rate. So, what I had mentioned before, this loan estimate usually comes a day after you lock in the rate, and it will tell you on here rate locked, and it should be clicked. It should be a little check mark that it says yes, your interest rate is locked. So making sure that that's locked, that the period's correct, and in other words, the term of the loan is correct, and the number of points that you're going to be paying, that's correct. If you have any issues with credit, ask how your credit history affects the pricing of your loan and what you need to do to change that. So a lot of times it's something very simple. Like, I know somebody that just had very little credit history. They have what we call baby credit. And baby credit is not bad. It's just not a lot of credit, so their score wasn't high, and they had, like, their history was great, everything was great, but it was baby credit, so their credit score wasn't as high as it could potentially be. I told them, I was like, you can see if your mom can put you on her credit card that she's had for the longest, and see if that can improve your credit. But, you have counselors available to help you with that, so they can give you tons of different advice. But that guy, it took, I think it was 45 days. He went from a 660 to a 780 in 45 days. So, sometimes it's a quick little fix, and sometimes it's going to take a little bit longer, but definitely get with your counselor, and they can give you tons of different ideas of how to repair the credit or increase it fairly quickly. So if we can go to the next one. So there's a lot of steps that you're going to have to take when purchasing a home. The first one is going to be the research and the education that you are doing now. The education part of it, knowing what to ask, is crucial. It's very important. Once you feel that you're ready to take that step, and your counselor can give you that information, connect with them and let them know that you want to go ahead and start the loan process. So doing the loan application, getting the pre-approval. So there's a difference between being pre-qualified and being pre-approved, which we'll go over a little bit later. And then processing, the processing and the underwriting process is going to be the one that's going to take the longest in the loan process itself. But if you do the pre-approval process, it can actually shorten that process quite a bit, the processing and the underwriting segment of it. And then there's the approval and the loan closing, which means you're signing, you're ready to get the keys of your first house. So we'll go to the next slide. So that step number one is the research and education. So being able to sit down with your housing counselor to review your affordability and determine if you are mortgage ready. Talk to friends, family, and coworkers about their experience when they purchase their own home. And then talk to a mortgage professional without any commitments. go online and do some calculations to see how much you can afford. It's always nice to do your own calculations so that way you can see like, oh, well, if I pay this off, then I can afford this much. Or, so being able to play with those numbers really helps. Like just you being able to see those numbers and being able to see like, oh, okay, like this makes sense. So then that way, once you're talking to the lender, then what they're saying to you makes a lot more sense. So you can take it in a different and know exactly what they're talking about when they're telling you, okay, this is what you qualify for this reason, or we can do this to help you qualify for more. And you understand where they're coming from if you play with those numbers a little bit yourself. And then where can you go for pre-purchasing coaching? HomeOwnership OC offers personalized counseling sessions to review your personal situation and get an estimate of how much you can afford. So doing the they actually help you do the pre-qualification process. So when you're going to the lender and running your credit, then you already know that you are prepared to get into a situation of home ownership. And that way you're not having to run your credit several times to find out that you're not quite ready. So definitely get one of the counselors so they can help you prepare for the home purchase, which is, like I said, it does take a lot of steps, but it is a lot easier than what people make it seem. So if we can go to the next slide.
Yeah, you know what, Veronica, we're running a little bit late, and so I had promised everybody that we were going to take a break, and it's already at 7.
Okay.
So if I can interrupt you and I can let people take a little break, and if you're able to come back, that's great. If you're not, that's okay too. But we're going to try and wrap it up before 7:30. So I try to keep it on time, but we're running a little bit late. So let me interrupt folks and give them, I feel bad because we've been on the workshop for quite a while and I haven't given them a break. So
Okay.
Are you able to come back in like 10 minutes?
Yeah, absolutely. We'll be able to come back.
Okay. Yeah, then let's go ahead and take a little break, just a 10-minute break so people can stretch and go get a glass of water, go to the bathroom, do all that. And then we'll come back at 7:10. We'll just do a quick little break. And then, like I said, we'll go through the slides fairly quickly so that we can make sure to get through with hopefully all of this by 7:30.
Okay, sounds great.
Okay. All right. Thanks so much. Well, and there are a couple of questions actually that we can go. We will answer your questions as soon as we come back from the break.
Okay.
Okay. All right. Thanks so much.
Okay.
All right. So go ahead and go do your break. We'll be back in 10 minutes. Okay, it looks like it's 7:10, so we're back to our workshop. So hopefully you had a good little break. I'm going to go ahead and ask Veronica the questions that I know you guys have been sending me a couple of questions. So let me ask those questions. Veronica, are you back?
I am.
Okay, perfect. So first question folks had was, do veterans need to have an honorable discharge to qualify for a VA loan?
So the certificate of eligibility, they will need to have an honorable discharge.
Okay, perfect. Another person says, I've already talked to a mortgage broker about many of these government programs. They told me that you pay more for your home, or you pay a higher interest rate or additional fees if you participate in them. Often the aid you received is zeroed out by the offset cost. Is this true? Are they a scammer? They did say they were HUD certified. So what about those government programs?
I mean, with the government programs, there are fees for the guarantee, but these normally a good lender will know, like, okay, if you qualify for a conventional loan, then I'm going to have you go ahead and do a conventional loan. There's a lot of community programs out there that require 3% down versus your conventional, typical loans that require 10 to 20% down. So, I mean, with the community loans that most banks have available, you can qualify for what we call either a portfolio loan or conventional loans within those community programs. If you don't qualify for those, then you definitely want to take advantage of doing the government program, because otherwise you're not like FHA, you're not qualifying for any other program. Or also the VA loan, I mean, honestly, there would be no, even if the customer were to qualify for a conventional or a community loan, a portfolio loan, I would put them in a VA loan because there's so many other benefits to having that VA loan, such as like no mortgage insurance, no down payment, 0 down payment. So even though they're paying the guarantee fee, it's well worth it to them. Because, I mean, who's going to give you a loan that is 100% like financed? It's
right.
And USDA is the same.
Right. No, we always say that too. VA is a great loan product and you should definitely consider it. And then do most lenders and loan officers know about these down payment programs and first-time buyer loans? Are they going to be able to help them?
I hope so. That's their job, but this is what we do on a daily basis. So I definitely hope that they would know about the different programs. Now, you do have some lenders that are specifically for like jumbo loans or wealth and stuff like that. So they might not be completely aware of it, but they do have somebody in their company that would be well versed with these type of programs that are available within that community. So
right. Yeah, and that's what we usually say. Try to find somebody who's familiar with down payment and that's going to work with you, answer your questions, and try to find you the best loan possible. Because it's a huge investment. So I'm gonna let you off the hook because we have to zip through some of these slides really quickly. So are there any additional questions for Veronica before I let her go? And of course, if you do have questions, you can always ask me and I can send them over to Veronica and let her know. But because we're short on time, I don't want you to have to rush through this information. But I do want to thank you so much for jumping on and providing your insight, because it's always best to get it from somebody who's actually doing loans and understands the process better than we do, and what's happening in the market. So definitely, if you guys have questions, feel free to outreach to us. And we work with a lot of lenders and loan officers that do know about first-time buyers. That's the only ones we work with, really, because the majority of our people are first-time buyers. So we can definitely put you in contact with folks.
Yeah, definitely.
So,
yeah, I just wanted to offer. Sorry, I just wanted to offer, Connie, if you do have, you know, any of your coaches that have a question while they're coaching somebody through the process, please feel free to reach out to me. I'll be happy to answer any of your questions.
Oh, definitely. Yes. And we do always have questions because things always come up. So I appreciate you jumping on real quick and helping out. You've provided some great information. So thanks again for helping out. I really appreciate it.
Thank you for inviting me.
Oh, sure. No problem. Okay. Alrighty. Okay. So apologize, we're running a little bit behind, but I promise I'm going to try and zip through stuff to make up some time here. So mortgage loan application is a lengthy document, has 10 sections, asks all kinds of detailed information about the mortgage loan, the property type, purpose of loan, borrower information, et cetera, et cetera. You're going to want to make sure you fill it out completely. And then Veronica was talking about pre-approval versus pre-qualification. So pre-approval is an actual written commitment from the lender for mortgage funding as long as certain conditions are met. Your information is verified. It takes more time and it carries more weight than a pre-qualification letter. Pre-qualification is a really quick process and just tells you how much house you can afford and how much money a lender might be willing to lend you. Your information's not verified. It takes about, 10, 15 minutes. So pre-approval is what you want when you're going to go out shopping. You want to know how much are you actually qualified for. They'll need income records, pay stubs, W-2s, tax returns, all of that is going to be needed for a pre-approval. Next, you go to processing and underwriting, where they complete your loan package by ordering credit, appraisal, property, and verifying your employment, all of that information, and then the underwriter reviews all that information and decides you're either approved or denied. Hopefully approved. So the two most important documents are the loan estimate and then the closing disclosure. Looks very much like the loan estimate. If you're approved, the lender will send a commitment letter which formally states the amount and the terms of the loan. Closing day is when everything is when your loan is completed. You want to double check your closing disclosure for accuracy. It should look very close to your loan estimate. You're going to sign documents, agree to pay the lender for the money, and then give the lender rights to the property if you fail to pay the loan. So again, closing disclosure, loan estimate, very similar. Terms, everything they're quoting you on the estimate should be close to your loan closing disclosure. Here's a big copy of it. Again, looks just like your loan estimate. A lot of times when we review this for clients, we'll find things, hopefully in the estimate, where they may be charging $5,000 for a termite, which is a junk fee, basically. So if you want us to review it, we're happy to review it and explain things to you if you don't understand what it is. But look at these documents really, really carefully, okay? Two of the most important documents when purchasing a home. So if your loan's not approved, make sure you review the reason why. Common reasons are changes in income, maybe your hours got reduced, new debt, you bought a car, insufficient assets, you're supposed to have money in the bank, but it didn't come through, or the value of the property is less than their agreed purchase offer. So if you agree to buy a house for $400,000, but the property value is $350,000, that means you need to come up with that $50,000 in difference, okay? Same thing happens if it's a bidding war and you agree to, pay $20,000 more than they're asking for $20,000, but the loan's only for $400,000, you're coming up with that $20,000. So you want to make sure you stay within your budget and what you're approved for, unless you happen to have that money laying around. Be very careful. Look out for predatory lending practices where they're trying to get you packing or adding like that $5,000 termite fee was a junk fee thrown in there. Had the client had not sent it to us, they wouldn't have known. Don't fall for high pressure sales tactics. Don't sign any blank documents, and don't sign anything you don't understand. If it sounds too good to be true, it probably is. So watch out for these things. A lot of times clients have told us, you know, they found things and came to us, and we were able to stop it, hopefully before they signed it. So you should feel comfortable when, you know, being honest with that individual that you're working with. And like Veronica said, shop around. If you don't like that person, go find another person. Try to find somebody who's willing to work with you. So you will be working with a real estate professional. Once you're qualified for the loan, then you'll go out shopping. A listing agent represents the seller. The buyer's agent legally represents the buyer. Both are paid by the sales commission of the property that's being listed, sometimes paid directly by the buyer. If you're using a dual agent, it means they're representing both the buyer and the seller, and may be paid by both. And you just want to make sure that they're still working in your best interest, because if they're representing the seller, they're going to work for the seller. If they're representing the buyer, you want them working for you. All right, so you can find your agent by doing your research, going online, talking to families and friends, research realtor organizations, Zillow, Trulia, make sure they're licensed to the Department of Real Estate, and ask questions. Interview at least 3. Make sure you feel comfortable with them and that they're responsive. The fact that, you know, it's kind of a difficult market right now, you need an agent that's going to really work with you and be very responsive. Discuss your needs and wants. Do your research. The agent's going to do all this work for you. They're going to research information on potential homes, give you access to the homes, help you prepare a purchase agreement, and negotiate for the best price. They're also going to refer you to other individuals such as home inspectors, etc. You want to be ready, respectful, communicate with your agent, and then you'll go shopping. There's single family homes, duplex, triplex, floorplex, planned unit development or PUD, townhouse, condo, manufactured home. So depending on what's going to work for you, you want to do the research. Typically, your realtor will talk to you about that. There's different types of sales. There's traditional sales, also short sales or foreclosure sales are real estate owned. Not a whole lot of foreclosures or short sales happening right now because most people do have equity in the properties because the properties are high in value. So majority of it is a traditional sale at this time. You're going to want to check out your neighborhoods, make sure you feel safe, look at the conditions of other homes, quality of the schools, how far are you commuting, do they have parks, public transportation, shopping, etc. Things that are important to you. Come up with a list of things that you want, your needs and your wants, right? So your needs you need to have, wants are just something you'd like to have, right? You may need to be a little bit more flexible during this time when there's very low inventory out there and not a whole lot in the first-time buyer, categories of the lower-priced houses. There's lots of online tools to check out neighborhoods and see if it works for you. Do your research on the area and the property so that you know what where you're buying. As you're looking for houses, you can go online to see what prices are. You can go to realtor.com, trulia.com, Redfin, Zillow. All of these will give you an idea if you're looking to buy in Santa Ana and you want to know what the price is to put 3-bedroom, 2-bath, Santa Ana, and it will tell you, yeah, this is what you can get for $300,000 or $400,000. Do your research. Most of the time, your realtor is going to do the research for you, but if you just want to do some research to see what are the prices of houses around me or in the areas you're looking to buy. You're going to want to do your viewing of homes by drive-bys, open houses, home tours. Make sure you take a camera, take pictures, write down notes, bring your spouse, family members, and view it at different times during the day. You know, maybe it's a very quiet neighborhood during the day, but at night everybody comes out and there's people on the streets, and or who knows. So view it at different times just to see and get an idea of what the neighborhood is like at different times. While you're viewing the property, check for issues. Make sure there's no water where it shouldn't be, structural problems, finish problems, building lines that are not straight or true. Write all these things down, ask questions. You're going to get a home inspection, and we're going to talk about that. So, you found your house. What your realtor is going to do is present an offer. An offer is a written purchase proposal signed by you and anyone else that's going to be an owner of the property. Before making an offer, ask yourself, have I been pre-approved? Most of the time, realtor's not going to go take you out looking at properties unless you're pre-approved. Ask how much fixing does the house require? Can I afford this as a new owner? Does it meet my needs and wants at the fairest possible value? How long has the house been on the market? If it's been on the market a long time, sometimes that's a big red flag. It's an idea of what the purchase agreement looks like. It's going to have your name, address. It's going to make sure everything is spelled correctly. It's going to have the property address. It's going to have the price that you're agreeing to pay for it. And then number of days you'll be in escrow. Most of the time it's 30 or 45 days after the offer is accepted. You're going to sign and agree to all terms of the contract. So you present your offer, then there's 3 possible outcomes. First option, your offer is accepted, great, you're going to escrow, you're going to be purchasing the property. The second option is the seller sends a counter offer, then you start negotiating. Your realtors will go back and forth, or the offer is rejected and you decide if you want to submit a new offer, if it's allowed by the seller. So when negotiating, know your limit. Know how much you're pre-approved for. Don't go over that limit. Remember that the offer you settle on is the one that you will have to pay and live with. So it needs to be within your budget. So they accepted your offer. Now what happens? As you go to escrow. Escrow is a licensed company or an impartial third party that holds the funds and then disperses them to make sure all parties are paid and contingencies are satisfied. Escrow is opened, and the time period between when the offer is accepted and the loan is approved, closed, and the deed is recorded. So that's that 30-day window when we have to get everything done. So within the first 3 days, you're going to give your earnest money or good faith deposit. That's the money paid as a deposit on the home. Usually it's 1 to 3% of the purchase price. If the sale is successful, your earnest money goes to down payment. Within 7 calendar days, you're going to give pre-approval letter to the seller, verify your down payment and closing costs. And within 7 to 17 calendar days, you're going to conduct your inspections, review reports, disclosures, request repairs, and remove any contingencies or cancel the sale. What are contingencies? Those are events or tasks that must happen before you or the seller can complete the purchase. If the contingencies are not fulfilled before closing, the sale is canceled, you get your money back. The typical contingencies include loan approval or financing. You didn't qualify for the loan for some reason. Appraisal, you're buying it for $400, but the appraisal came in at $350. Home sale, like you have to sell another home before you can buy this home, or there may be title issues. Now, what's the difference between a home inspection and an appraisal? So a home inspection evaluates the structural or mechanical soundness of the property for the buyer. whereas the appraisal determines the property's fair market value, and it's on behalf of the lender. So home inspection is very important for you to get as a buyer because it may change your decision on whether to purchase the house. It could save you money on possible problems you didn't know, and it reduces your chance of costly surprises. Very important that you get a home inspection. Inspectors come from either American Society of Home Inspectors or the National Association of Home Inspectors. Usually your realtor will work with some, and they will refer you to some. It will cost between $300 to $500, and it is an upfront cost that you're going to pay as a buyer. Very important that you get this home inspection so that you know what's wrong with the property. This person goes through the property, provides you with a report at the end of it, and tells you what problems they see. It's a good idea, if you can, to meet the inspector at the property and go through it with him after they finish their inspection or during as well. Some red flags are, of course, environmental hazards, moisture in the basement, defective roofing. Roofs are very expensive. Our flashings, termite or insect infestation, chimney settling or separating, those are very big red flags. So we had a buyer who sent us their inspection. It had 25 things on it, including the roof, the foundation, and all of them. It was like, why are you buying this house? And they decided they weren't going to go through with it, but they were so desperate they were actually considering it. So home inspection can make the difference in you determining whether or not you want to purchase property. So it's a small amount to pay to know what the condition of the property is. Very important, HUD wants us to remind you, for your protection, get a home inspection. There's also a title report or title insurance that you'll have to get. And title report is a legal document from a title company, describes the property and shows all of the liens on the property. Title insurance insures the lender or a property owner against defects in title or challenges to their interest in the property. So you will have to pay for title insurance. It usually protects the lender, but it makes sure that the property is clear of all of the liens. So your closing tasks, you're going to do a final walkthrough with your agent, verify the condition of the property, purchase homeowner's insurance, usually combining with your car insurance, you can get a discount. Get a copy of your closing statement, make sure it looks just like your loan estimate, right? Sign all loan documents and provide down payment and closing costs to escrow. And then escrow closes when the loan's been funded. They notify all parties of closing, record the title at the county recorder's office, and you get the keys. All right, any questions on the process? All right, so again, we're zipping through this. So you will have to get homeowner's insurance or hazard insurance. It's insurance that covers home. It's required by the lender, protects your asset in the event of structural damage, pays to replace personal belongings within the home if they're stolen, and provides liability coverage in case accidents happen. You'll be covered for fire, structural damage, liability, theft, temporary living. You can also get additional coverage for earthquake, expansive soil, flood, hurricanes, landslide, etc. You want to shop for your homeowner's insurance, replacement cost versus actual cash market value. Replacement cost is just the cost to rebuild or repair your home with similar materials, whereas actual cash market value pays for your loss, but often doesn't pay enough to fully repair or replace the damage. Shop around, get 3 quotes, ask questions, make sure the company's licensed, and look for discounts when you bundle with your auto insurance. So there's a difference between a home warranty and a home insurance. Home warranty covers plumbing, electrical, heating, and appliances. It costs between $250 and $500 a year. It is optional, and service fees are typically between $50 and $100. So if something breaks down in the house, you call the warranty company. They call a home appliance repair person, comes to fix the place. All expenses are covered, but you just pay for the service fee with that $50 to $100. And homeowners insurance, as we said, covers the damage due to the property because of fire, wind, theft, etc. Usually costs between $300 and $1,000, and only covers the cost of the repairs. They do not hire contractors to make the repairs. You'll do that. All right, for fair housing, we're all protected under federal fair housing laws, and we're protected classes due to our race, color, national origin, religion, sex, familial status, which means the presence of children under the age of 18, and disability. Under California law, each state has their own fair housing laws. Under California laws, it also includes sexual orientation, gender identity, expression, marital status, medical condition, ancestry, source of income, age, genetic, and arbitrary discrimination. The Federal Fair Housing Act covers rental housing, purchasing, selling housing, insuring housing, appraising housing, lending, nursing homes, permanent shelters, other places where people live. What is housing discrimination? It's blocking someone's access to housing, treating a buyer, renter, or purchaser differently, or just denying someone the right to buy or rent a home even though they can afford the property, just because a person is part of that protected class. So, big picture here is if something doesn't feel right, you have questions about it, contact us. We'll put you in contact with our fair housing experts at the Fair Housing Foundation to investigate. Prohibited acts include refusing to sell, lend, rent, or lease housing, represent that a dwelling is unavailable for inspection or sale when it really is, providing different terms or conditions, canceling, terminating home loans, credit applications, etc., threatening, intimidating, or making unlawful inquiries as well. So in real estate, some examples of discrimination would be lying or exaggerating sales term, failing to inform you of all listings, stalling to show a home, running discriminatory ads, refusing to negotiate with buyers, or steering to certain neighborhoods. Maybe they say, oh, you'd be more comfortable here in this neighborhood because it's professional adults, meaning no kids, right? Or this area because it's predominantly Hispanic or Vietnamese or whatever it may be. That would be a form of steering. In mortgage, it's illegal to scrutinize one loan application more closely than another, give unreasonably low appraisals, impose different loan terms or conditions, or deny loans in certain neighborhoods, also known as redlining, or targeting borrowers based on protected class. Like, for instance, we only advertise on Spanish radio. That would be, it could be considered discriminatory if they're doing that specifically because they're targeting Spanish speakers. In lending, same applies, steering applicants towards bad or inferior loan products, unnecessarily requiring a cosigner, providing inferior servicing of a mortgage loan, denying loans to pregnant women because they're going on maternity leave, or requiring them to go back to work, approving or denying loans based on protected classes. All of that can be considered lending discrimination. And again, if you have questions about it or you feel like somebody may be discriminating against you, you can let us know. And we'll put you in contact with the local fair housing agency. There's overt discrimination, openly or intentionally discriminating based on their protected class, like we don't lend to single women because they don't make enough money, or disparate treatment where members of a protected class or group are treated differently than others, and it can be unintentional. Maybe they have a pricing discretion that results in white applicants receiving better products than Asian applicants. We talked about redlining, and also disparate impact can occur when otherwise neutral policies or practices have unintended consequences of creating disproportionately adverse impact on protected classes. Again, something doesn't feel right, or if it's a red flag, let us know, and we can do more investigations and help you with advising you of your fair housing rights. Beware of lending discrimination, such as refusing to provide information about all mortgage loans, steering to high-cost loans, putting unnecessary closing costs or recording fees, inflated appraisal costs or broker lender fees, aggressive solicitation of credit terms, unnecessarily requiring co-signers, undervaluing properties because of their race, national origin of the residents in the neighborhood, or offering more advantageous loan products in certain neighborhoods. All of these can be considered types of lending discrimination. The Equal Credit Opportunity Act is a federal law that makes credit discrimination illegal and holds lenders responsible if they break the law, covers all of those protected classes we talked about: race, color, religion, national origin, etc. And the fact that all or part of the applicant income comes from public assistance, or that the applicant has in good faith exercised any right under the Consumer Credit Protection Act. It covers car loans, credit cards, home loans, student loans, basically all types of loans, right? So again, if something feels like it may be wrong, or that they're not treating you fairly, you can always investigate. Some examples of discrimination may be rejecting a credit application based on consumer's protected characteristic, changing credit terms or conditions, asking if the consumer receives alimony, child support, maintenance payments, asking if you're widowed or divorced, asking information about consumer spouse, refusing to consider public assistance, or offering credit with higher rate than they applied for, even though they qualify for a lower rate. Okay, so as in foreclosures, discrimination may be refusing to provide the same forbearance terms to all protected classes, providing less favorable loss mitigation terms, denying forbearance to individuals in certain protected classes, failing to explain available foreclosure prevention policies, or having harsher collection or foreclosure practices. There are rights for disabled individuals, buyers, and renters. A disability would be any physical or mental impairment that limits one or more major life activities. And you do have the right to make reasonable modifications and be granted reasonable accommodations for full use and enjoyment of the property. And basically everyone in the housing industry can't refuse to deal with you or treat you differently because of your income or your disability. And they, if you get disability income, they should not be treating you any differently. As far as COVID and fair housing, it is illegal to deny housing due to being from one of the countries affected by COVID. Illegal to have different rules for persons because they are from a country affected by COVID or perceived to be from there. And it's also illegal to refuse to sell, make a loan, offer credit, or rent because you're profiled based on race or protected classes to be associated with COVID. And COVID-affected individuals can be covered by the disability protections if they have COVID, have a disability due to COVID, or are taking care of someone with COVID. All right, we're not going to go through these examples because I know we're running short on time here. So, safety precautions, make sure you have emergency numbers, have your smoke detectors, fire extinguisher, escape plan, emergency prepared kit. Remember your equity is the current market value of the property minus the amount owed of any outstanding mortgage. It's an asset that will help you build your financial future. And when you borrow money using your equity, it's called a home equity loan. If you don't repay it back, the lender will collect your home as collateral. So be very careful. That equity is, you know, your asset. So don't want to utilize it like a piggy bank or before getting any kind of equity loan. It's really important to check out Energy Star programs and benefits. Energy Star is a program that provides certification to buildings and consumer products, a lot of appliances, which meet energy efficiency. A lot of the gas and electric companies will give you discounts if you buy Energy Star products. And you can look to your electric and gas companies to see what kind of discounts they offer. So what comes next? If you're already approved for a loan, you're going to forward your home buyer certificate to your lender or down payment program. If you're ready to get pre-approved, you're going to contact the lender, see how much you can qualify for. If you're not sure where you're at or you want to learn more or you need to improve your credit, then you're going to contact us, meet with a housing counselor, and they'll create an action plan for you. What are the best ideas for successful homeownership? Avoid risky loans, make your mortgage payments on time, stay current on your property taxes, maintain adequate insurance, keep your home in good shape, keep an emergency fund ready, and avoid borrowing against your equity for consumer purchases. If you are having trouble making your payments, contact us. We can provide you foreclosure prevention counseling and help you save your home. All right, as you're going through the process, you're going to want to make sure you read all the documents, ask questions, get help from us, know your budget, stick to it. Make sure you check out your realtor at the Department of Real Estate. Check out your lender at the NMLS, consumeraccess.org. Make sure they're licensed, they don't have any things against them. Also, look for down payment programs in the city, county area that you're looking to buy. Most cities, counties, states have down payment assistance programs as well as banks. Shop around, look at 3 lenders. And you did that one part, educate yourself. So you did a great job of educating yourself tonight. So next step, if you have not completed your intake form, please do so. I will need that in order to provide you with a certificate. We will be following you up after the workshop to see if you're interested in individual counseling. If you've completed the intake already, no problem, we can use that for your individual counseling session, and make sure you complete the budget section. So once I have all of that information, I will be emailing you out your individual certificates, and you'll be good to go. All right, so any additional questions? I know we zipped through the last part of it. I apologize, we're running a little bit late. We're running a little bit long, but I want to make sure that I get to all of your questions. So please send me any questions you might have in the chat box or the question box, and I'll be happy to answer it. I see a couple of questions came through. The down payment assistance program is something that the bank could help with, or is this something I have to apply with myself? So depends on if you're applying for the bank down payment assistance, then they will tell you what you need to do to qualify for it. If it's a state program, you would probably get the application and apply for it individually. Again, I would work with somebody that if that they know about first-time buyer loan programs and down payment assistance programs in your area. And if you need help with that, let us know, because we do work with a lot of different lenders, and we make sure that they know about all of these programs. Another question is, if I start a new job, what will be the time I'd have to wait to be able to apply for a conventional loan? So typically they want to see at least 2 years employment. Now, if you're going from the same industry that could be an exception, like if you work in software and you're just going from one software company to another software company, it wouldn't necessarily be the full 2 years, but you'll have to check with the lender to make sure that will be okay. But for the most part, if you're staying in the same industry, I don't think you have the 2 year. It will probably be a couple of months. All right, so you will get certification at the end of the class. It's a first-time buyer HUD certificate, and it is good throughout the nation. So it doesn't matter, even if you're outside of California, it will work in any area. Sometimes some of the state or county programs want you to take classes with their specific nonprofits. That I can't necessarily change. So they may ask you to do a class with their specific nonprofits, but for the most part, they just want a HUD certified agency to provide you with a home buyer certificate. And as long as I have your intake, I will be able to provide that for you. All right, any additional questions? You can get the intake form on our website. I'm going to put it in the chat again and in the question box. There you go. Any other questions you guys have? All right, well, I apologize that we ran a little bit over time, but I think you got some really good information. Hopefully, we answered all of your questions. Again, if you do have further questions, you can contact me. You have my information. I will be emailing you after the class, most likely tomorrow, asking if you'd like individual counseling. And then if I got your intake form and it was completed, then I will send you out your home buyer certificate. And again, if you do need individual one-on-one counseling, we're happy to provide that. We can create an action plan for you if you need to work on building up your credit, creating a savings plan, or you just have questions, you want us to review your loan estimate or loan programs, help you find some loan programs in your area, we can do that as well. Our contact information is homeownershipoc.org on the web. Email cdt@conniedt.com, and our phone number is 714-204-2314. All right, it looks like I don't have any additional questions, so I want to wish you all a very good night. Really appreciate you joining us for the workshop tonight. And again, if you do have any other questions, feel free to reach out to us. We're here for you. All right, have a great night. Thank you, everybody.